Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry.
Folks, the Super Bowl of Macro Week is behind us. A slew of mega cap earnings, auctions, and Treasury borrowing announcements, an FOMC meeting, and NFP as well. Let's not forget the highly anticipated Truth Social broadsides leveled at Powell. These did not disappoint. The market did finally get some motion on that jobs report, a reminder that 6 realized vol on the S&P over a month isn't all that sustainable. And as expected, we enthusiasts for the sport called high finance have spent the last few weeks doing our very best to map cause and effect. Attribution, crafting narratives that help account for price change, is a favorite hobby among us. Take that away from us and we'd have very little to talk about. Spoiler alert, when there's no motion in assets, we sometimes encounter blind spots as investors, missing the big picture of risk. The ground may be shifting beneath our feet, but muted volatility on a daily basis prevents us from recognizing it. I've got a bunch on my mind, but let me start with a chart I recently posted on the old tweeter. I showed the changes in implied probability of September eases by day since the May 7th meeting. Since that time, the largest decline in cuts came on July 3rd, the June NFP day. After that, we'd been hanging around 2/3 of a cut until that FOMC meeting when, in most everyone's view, the press conference was on the hawkish front. As per that presser, the last time Powell has spoken publicly on the economy, I heard things like, quote, inflation is above target, and, quote, we are near full employment, and, quote, the economy is in a good place. The bar seemed high for getting the process underway in September. The FOMC press conference sharply reduced the odds on September, but that was fully reversed and more due to the NFP revisions a few days later. The BLS commissioner was sent packing, and not just on a seasonally adjusted basis. You can't make this stuff up. So, while rate vol measures like the move are at their lowest points since the onset of the 2022 tightening cycle, there's been a fair degree of recent movement in Fed probabilities. I often say that market risk measures respond not just to the direction of Fed policy change, but the conditions under which such change was decided. Is the Fed easing because it can or because it has to? The move responds differently based on the circumstance. If it's tightening because you can, rate vol can be low, a la the modest 2016 cycle. If it's tightening because you have to, a la 2022, rate vol will be very high. The big difference here is the extent to which the market must wrestle with the ultimate stopping point on the hiking cycle. It's similar on the easing side. If there's a growth and labor market urgency to it, March of 2020, for example, it's likely associated with a higher move, but also a higher VIX. Of course, there are other factors impacting the clearing price for interest rate vol, including the level of rates, central bank bond buying programs, macro event risk like elections, and the overall backdrop of supply and demand for optionality. Well-supplied markets, perhaps where there's an overhang of options that have been sold in order to capture return in sideways environments, might be associated with lower clearing prices for implied volatility. If, instead, the market finds itself without a lot of capacity to bear convexity risk, vol likely clears at a higher level, necessary to bring option sellers to the table. As we approach Jackson Hole and folks look to better understand if Powell is where the market is on September, it's worth recalling the last time the Fed eased and the atypical, perhaps troubling behavior of the back end over that time frame. In summary, 100 basis points of cuts to the policy rate from SEP to DEES 24 coincided with nearly the same amount of increase in 10-year yields. This is not to suggest causation, but it is to highlight that easing of policy is certainly more effective if the long end of the curve has at least some positive beta to changes in the front end. After all, the Goldman Sachs Financial Conditions Index, a measure that incorporates various market prices to measure their collective impact on the economy, puts far greater weight on long-term rates than it does on the policy rate. A lower policy rate and steeper curve is surely good for deposit-taking institutions and perhaps less good for Warren Buffett in his $300+ billion haul of T-bills, but the Fed would clearly prefer the long end to come in as well. With this in mind, I saw a few posts on the 2s 30s curve on X, and it got me thinking. While this curve doesn't get as much attention as the 2s 10s does, it does have some good information content right now. 2s are generally a decent proxy for where the market thinks the easing cycle may land, plus some basis points for slope and carry. 10s and 30s are often lumped together as the quote long end. But that spread has been widening recently, a function of what I think is a governance and fiscal credibility premium that grows with maturity. Would you lend without thinking about it carefully to USA Inc. for 30 years? It's going to be really interesting to see how different points in the curve behave over the coming months. The Fed confronts a tricky dual mandate and feels off track, and the politics are ugly. Will the decision feel politicized, and might that impact market pricing? Tariffs, like monetary policy, likely operate with long and variable lags. But will they serve to increase inflation, decrease growth, neither or both? There's lots of uncertainty. And that, my friends, is the main topic of conversation at hand today: uncertainty. To kick things off, let me read to you 4 quotes that serve as a cornerstone of my philosophy on uncertainty. I'll start with Mark Twain, who said, "It ain't what you don't know that gets you into trouble. It's what you know for sure that just ain't so." I love that one. Next, let's move on to the great Hyman Minsky. Success breeds a disregard of the possibility of failure. And who can forget Voltaire? Doubt is not a pleasant condition, but certainty is absurd. Overlaid on these 3 timeless quotes on uncertainty is this beauty. Quote, "It is hard for us, without being flippant, to even see a scenario within any kind of realm of reason that would see us losing $1 in any of those transactions." That comes from Joseph J. Cassano, head of the AIG Financial Products Unit, in August of 2007. I love the juxtaposition here. Of course, Cassano wound up being central to AIG needing an $80 billion bailout from the U.S. government just days after Lehman went under. There's a great scene in Too Big to Fail, where Chris Flowers, advising B of A on potentially buying Lehman, gets a surprise call from the CEO of AIG on Lehman weekend saying, quote, "We are about to run out of cash," asking if he can send some numbers to Flowers for review. It turns out that AIG Financial Products, the booking entity of Cassano's amazing foray into subprime CDS, was not even aware of the term variation margin under ISDA when the likes of Goldman began calling for collateral in 2007. Anyway, investing is always done under vastly incomplete information. You've got to not just accept it, but also embrace the reality. Once you do, you will instantly realize that risk is about being missized, having more volatility than you expected, and perhaps most importantly, making decisions you don't want to as a result. Everyone is a long-term, mark-to-market insensitive investor until they are not. You've got to be really careful on sizing. Getting sizing wrong is some combination of underestimating the volatility profile of the individual assets that you own and also the degree to which they are correlated. LTCM famously saw no correlation between swap spread convergence trades and being long Danish mortgages. I often come back to the observation that volatility and correlation are themselves highly correlated. That is to say that with incredible consistency, the constituents of the S&P will become more correlated at the same time as they become more volatile. The very same set of macro uncertainties that boosts volatility of individual securities also leads them to become more highly correlated. We certainly saw this in the tariff tantrum, hat tip Corey Hofstein for the term. 1 month realized correlation of Apple to Nvidia was 88% in April, up from 0 in late February. At the same time, Apple's realized vol went from 28 to 80, Nvidia's from 45 to 90. Count me as highly suspect that the current 3-month realized correlation on the S&P of 11, which is in the 5th percentile of observations over the last 5 years, is all that sustainable. When considering monetary, economic, financial, and increasingly geopolitical sources of risk, there are just too many macro crosscurrents. Sizing should also be contemplated in terms of one's ability to change his or her mind along the way. Optionality is all about the right to change your mind. All else equal, my capacity to unwind expeditiously with no market impact is desirable versus having no or at least compromised exit liquidity. I saw a post on Twitter on how time and volatility are linked. We might also say that time and optionality are linked. To run out of options is really to run out of time. In option trading, one mistake made by investors is to underappreciate this linkage. Investors are often drawn to buy very short-dated, low-priced options. Take the obsession with the zero DTE complex. These possess very little time value because there's very little time left. They are optically and nominally quite low in price, but they seem cheaper than they really are. The opposite is also true. Investors often sell longer-dated options, failing to appreciate just how meaningful the impact of time is. In contrast, these options actually seem more expensive than they are. The 1x2 put spread is a good example. Buy the 1-year 100 strike put and sell 2 times the 90 strike put for even money. Break even is at 80, but only at expiration. The Greeks and the mark-to-market experience can turn ugly along the way. While it's often sold as a hedge, it's anything but. A year is a long time. 3 to 5 years, often the time capital is locked up in private vehicles in eternity. From 2017 to 2020, a span of 4 years, the VIX basically hit a new all-time low and a new all-time high. Locking up capital may yield excess returns that are worth it, but make no mistake, you lose a lot of optionality when you forsake the ability to unwind early without any penalty. I often suggest that periods of calm in the market can cloud our thinking about risk. In relationships, they say that absence makes the heart grow fonder. In risk, however, absence gives us nothing to ponder. Back to the ultra-competitive sport of attribution in markets. When nothing's moving, it's difficult to point the finger in any one direction. Playing whodunit when nothing was done is useless. I suppose, as the gamma bean counters often do, we can just say that the market got caught in a gamma well and couldn't move its way out of it. But let's put some of the recent low vol in context, shall we? As July rounded out, 1 month realized vol on the triple Q clocked in at 7.4%. The S&P, 6%. Go back a full decade, incorporating 2017, the lowest realized vol year since the early 60s, and you are still in the 3rd percentile of all observations. And the 1 month realized correlation among triple Q constituents got to an impossibly low 2% at that same time. The raging calm has left vol lower, but clearing at a pretty high VRP, vol risk premium. Options can be low nominally in price, but also expensive relative to realized. When realized vol collapses, the pull lower in implied is inevitable. As we seek to understand the feedback mechanisms in markets, one of the most reliable is the relationship between realized and implied vol. It's probably the case that realized vol explains 70 to 75% of the time variation in implied volatility. But the impact is more or less at different points on the vol surface. When realized vol sputters, all vols come down, but out of the money put vol is the stickiest, and the result is a steeper strike skew. For example, 3-month 90% put vol on the S&P is at 21.2, fully double the 10.7 for the 3-month 110 call. That's in the 72nd percentile over the last 3 years. Even tighter skews are also steep. The 3-month 95-105 skew is in the 80th percentile. That's essentially the meat of the risk reduction in the quarterly collar, which buys the 3-month 95 put and usually sells something like a 3-month 105 call. It's absorbing too much skew. I recently did 2 podcasts on this, one with Dan Villalon of AQR, the head of portfolio solutions there, and Ben Eifert, the founder and CIO of QVR. Their work, done independently, suggests there are better ways to reduce risk than a 3-month put spread collar. For me, insurance, in addition to the diversifiers of gold and Bitcoin, is part of my GOAT portfolio, great opportunities and threats. I've advocated for 2 to 3 month 95-80 put spreads on the S&P, but without selling the 105 call. The 3-month 95-80 skew is in the 76th percentile over the last 3 years. The cost of that put spread is around 1%. It's reasonably priced liquid protection. The protection helps you stay long, for a cost, of course. The big question, as always, in insurance markets is the price a good deal? I argue that now especially, spending 1% a quarter is sensible. I'll acknowledge that it's no doubt easier for an unconstrained investor who need not consider the business implications of falling behind a benchmark, but my view is that now especially, it's a sensible time for such an overlay. Those bad days of early April do feel like a long time ago, and we might cross a second, quote, Liberation Day off of our lists of things to worry about. But a wild chief executive with an incredible capacity to wield power remains, likely even emboldened by the episode earlier this year. As we consider the gravitational pull lower in option prices from a market that barely moves, I want to share some of my thinking about how to quantify this stability. I wouldn't want to cross them on Twitter, or in the gym for that matter, but I've always found Taleb's anti-fragile concept extremely useful. Take an idea and then think about the anti of it. Today's level of equity market diversification comes about through anti-correlation. What about the anti-VIX? Well, we can argue that was very much a 2017 regime when our trusted fear gauge closed below 10 more than 50 times. We might also actively measure anti-volatility, and that's my thought here. Instead of indices of market instability like credit spreads and the VIX, evaluate its level of stability and think about how that feeds back into wealth, psychology, and risk-taking. I posted this on Twitter, my Market Stability Index, or MSI. It's not rocket science. It simply counts the percentage of days over a 3-month period that the daily move in the S&P is less than 75 basis points in either direction. Currently, the MSI reads at 75, meaning 3 of every 4 days has a move smaller than 75 bips. That is extremely high and puts it in the 94th percentile since 2023. Overlaid in the chart I posted is the CBOE Gamma Index, which I've been following and find really useful. The index is a running tally of the P&L from a strategy that buys weekly S&P straddles and delta hedges them. The surging MSI, where the recent daily index moves have been impossibly, but for 2017 low, is the pain experienced by the Gamma Index. The surging MSI is a tailwind that feeds into the vol control complex, dictating greater exposure. It's also vastly at work in our internal risk barometers and how we consider potential outcomes. When the swings become as narrow as they have recently, our capacity to spot danger can be compromised. We can only think about what we see. And we operate in the dark when realized vol is 10. Attribution is all about accounting for a price reaction. It's tough to underwrite a cause when there is no effect. There are a few key things to remember here. First, as suggested earlier, there are few more direct linkages than that between realized vol and the payoff to being long gamma. As they say, quote, theta is the rent on gamma. And when the realized vol engine sputters, I like to add that, quote, the rent is too damn high. Market stability makes it so, effectively raising the rent of owning options. The marginal price setter of an option is the vol trader who considers an option's price in light of the cost to replicating it, which is always linked to realized vol and the extent of the daily swings. That trader has had to reevaluate that option price, mostly by allowing it to drift lower. Even as this has occurred, losses have mounted as illustrated by the plunging gamma index. The vol seller, conversely, is feeling emboldened and rewarded. He's the flip side of that falling gamma index. Back to Minsky, quote, success breeds the disregard of the possibility of failure. I find this very valuable insight. Sometimes markets get caught in low vol moods. As we round out the summer, the market chaos of tariffs has, for now, receded. 1 month realized vol in the S&P peaked at 51 in early April. It's now 10. Tomorrow unfolds mostly like today kind of stuff. This is really one of those periods. It should not, however, be equated to a backdrop that is actually becoming safer. A good case can be made that the backdrop is becoming definitively more risky. The price of insurance is a good deal versus the totality of risks. I see opportunity in long options. To be sure, option prices are definitively not cheap to backward-looking realized volatility. They rarely are, but for circumstances where there was a burst of realized, like early April, that came and went. Options are, however, valuable in light of a building of uncertainty in the economy, in Fed policy, in tariffs, in U.S. debt, and in a dangerous escalation in not just global affairs, but in the U.S. political civil war. The Main Street media may have TDS, but it's impossible not to observe just how many issues of controversy Trump is entangled in and is the chief sponsor of. Fed independence, firing the BLS chief, and Powell perhaps, tariffs on gold too, calling for the firing of the Intel CEO, the GS chief economist, the Texas redistricting fight, and what looks like the Dem aggressive response. Something may break, or at least those watching may react, including the ratings agencies that have cited the erosion of U.S. governance as a risk factor. To be 100% clear, there's not an ounce of partisanship in these statements. It's only to observe the escalation, which is set against risk premium levels that leave little margin for error. I'm not a big believer in market seasonality, but perhaps in Pavlovian fashion, late September through October tends to be associated with a pickup in market volatility. The question then becomes one of trade construction. Alas, the same setup that made VIX call options incredibly cheap as hedges that I'd highlighted around June of last year is no longer in place. Both vol and vol are reasonably higher. There are other places to look, however. In addition to the simple 3-month 95.80 put spread on the S&P, one of my favorite hedges is in the HYG. These options are impossibly low in price because the realized vol has been impossibly lower. The HYG is moving less than 20 basis points a day over the last 2 months. No surprise, post the tariff tantrum, we've seen a near full reversal of credit spreads and credit implied vol. If you are a believer, as I am, in the notion that sometimes realized volatility collapses for no particular reason, it makes the entry point on defensive option trades out to October and November compelling. Realized has pulled implied down, but realized does not reflect the underlying risks. Let me round out this discussion by summoning one of my little sayings, which takes Mark Zuckerberg's "move fast and break things" quote and reorders it to "move fast and things break." Markets can't withstand volatility that is ultra high for too long. We are clearly not in that circumstance right now, and it's certainly not the case that when things move slow, they break. But we ought to recognize how much runway market stability provides for risk-taking. Wealth gets generated, losses are small, few, and far between. Psychology may also especially be impacted when it's not just one, but every market that experiences the quiet. They say there's always a bull market somewhere, but in realized vol, it's not easy to spot. Perhaps the bull market is in market stability itself. An index I created on Bloomberg and posted on X measures the average of 1-month realized volatility on the S&P, TLT, GLD, HYG, Euro, Oil, and Bitcoin. It's in the second percentile over the last decade. It can be difficult to perceive change in underlying conditions when market prices are a frozen rope. Sometimes option prices fail to capture forward-looking risks because they've been weighed down by a stretch of paltry realized vol. Now may be one of those times. Take a good look at your book and do your best to entertain unwelcome scenarios and the P&L impact of them. Rainy day insurance is cheap to buy after a long stretch of sunshine. That's basically what this period of calm amounts to. Folks, I've reached 3,500 words. I hope this has been interesting, and I wish you a fantastic week and end of the summer.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.